All right, well, welcome everyone. We are here again with Matt Corbett, President of ZRG Embedded Recruiting, Jake Rapp, Managing Director of Canaccord, and Joe Marino, Chief Growth Director of Human People Solutions, for part one of the Foundations of Mergers and Acquisition. So I'll hand it off to Joe to kick us off. We'll go to our process.
Yeah. Thanks, Lamee. Yeah, today we're going to spend time or continue to talk through all the stages of the M&A process. And we'll start with just a brief recap. We have 8 stages in total. Lamee, did you want to show the 8 stages? Last we're together, we talked about the first 5 stages, or why sell all the way through the pre-selling stage. Today, we're going to talk through the selling process, which is our 6th stage, and spend a little bit of time on the post-close. I'll do a brief recap of what we covered last time. So when you think about why you're selling an organization, right, the advice that the 3 panelists gave were to make sure that you know what you're looking for, right? So are you selling because you're looking to de-risk? Are you looking to provide opportunities to your leaders in the organization? Are you looking to grow? Do you feel like there's some risk that if you're a smaller business, if you're part of a larger business, you can grow faster and have less overall risk in the business that something happens unfavorably? We talked about knowing your business. So actually, what is the business that you're in? You may be in 5, you may provide 5 services to your customers, but if one of those services represents 80% of your business, that's actually the business that you're in, and that's what you should lead with when you're talking to potential buyers. The next stage, stage 3, was know what you want. So what is the outcome that you're looking for? Right? Are you looking to make sure that your team members have a great cultural fit with the potential buyer, right? As a seller, is that important to you? Understand some of the consequences if you make some wrong changes, right? So if you're looking to have a quick process and you're going to go through a detailed process, or you're okay with the process being a little bit longer because you've got other priorities, then understand some of those things. And then we sort of titled it Engaging in Dating. So make sure that you're talking to people that are smart and that are educated within the M&A process. And so that can be someone that you know, but make sure that they're current on what their expertise within M&A, right? If they did a deal 3 years ago and then they did one 2 years ago, but it's not their core competency, they can provide you small amount of advice. But if you're really trying to have the best overall representation, find someone that is spending their time in M&A. They've done a lot of transactions. They can give you current information. It's great to have information from 3 years ago and 10 years ago, but what's happening today is very different than what happened 6 months ago. And those are real deadlines. What happened 2 months ago, pretty similar. What happened 6 months ago, it's very different. And then we talked about pre-selling. And so understanding who your potential buyers are, right? Is it going to be a strategic buyer, someone that is already in your industry or in a complementary industry that's going to be maybe looking at many synergies? So your back office functions, those team members may not move forward with the transaction because it's a synergistic opportunity for them. And then today we're going to talk about the selling process and what that looks like. So Jake, I'll let you sort of kick us off with defining how you all see the selling process, and then Matt, will go to you to comment on any differences and some other complementary comments.
For sure. Thanks, Joe. So I'll preview this for the group by mentioning this is a description of the process in the context of a formal M&A process, right? So you've hired an advisor, you've decided to formally take the business to market. It's going to be in the context of talking to multiple parties when you're out in the market, or you're finding different partners. It can look a little bit different if it's more of a fluid or one-off situation, but I'll use this to kind of describe the full breadth of the work that gets done in order to get to a closing. And so think about it in 4 stages. So the first stage is preparing to go to market. So this is where you're compiling a lot of the information and data that's going to be required to also prepare marketing materials, right? So if you're talking to multiple parties, you want to have a single set of marketing materials that people are basing their review on. A lot of our clients will a lot of times recommend that they consider and perform a quality of earnings analysis, which is just it's an accounting exercise to that looks very similar to what the ultimate buyer would do later in the process. So it's really a risk management tool to, take a credible set of numbers and present it in a context that buyers will be very familiar with. So that's always something to consider. We're also going to be working through identifying the right targets, right? So that's a very collaborative process with the sellers often to identify, who would be the right fit, how big should the list be, who are the right partners. That again, to part one of our conversation, who are the parties that meet your objectives, and aligning them all at the same time and in the same list to go to at once. So that's really part of the preparation process. So at the end of stage one, that's when you enter the market. So stage two, you're in the market. So we're out talking to, interested targets. We're getting them to sign non-disclosure agreements that, given the sensitivity of the conversations, we're sharing marketing materials and answering their initial questions. A lot of times we're, sometimes providing data or compiling data to be shared later in the process based on the initial questions that you're getting from interested groups. At the end of that first stage of marketing is what we call initial indications of interest. So this is a non-binding proposal for the business that tends to be, can be light in detail, but really just provides a framework to sellers or to target companies what a deal could look like in terms. A lot of times it's a range of value and basic structures that are contained in that initial indication of interest. So that's the end of stage of that first stage of marketing. We're getting indications of interest. We typically will sit down with our clients at that time and then the sellers and identify who among these are actionable and we want to move forward in the process, right? So if based on those initial proposals, some won't be interesting, we'll part ways with a lot of those groups. But the ones that are interesting and actionable will move forward into the next stage. So the next stage of the process, it starts with formal management meetings. So far, interested parties have been hearing from, haven't had the chance to interact directly with management teams a lot of times. And so that initial stage of this part of the process is meeting the management team, hearing the story directly from the company itself, and getting the opportunity to start to develop a relationship, start to get a sense of culture and the fit there by interacting directly with the company itself. Following those meetings, again, assuming they go well, and we want to continue to work through potentially interested parties there, the next stage would be to allow them into a virtual data room. So a virtual data room is basically a deeper dive on the documents and the data of the company. So a lot of times we'll be working in the background when the business is in that initial marketing phase, compiling documents. And so after management meetings, a lot of groups will dig into the data room, come back with initial request list, and that'll be a little bit of a back and forth for a few weeks. And at the end of that second stage, where it's managed meetings, it's data room, it's initial diligence, at the end of that second stage is what we call final proposals or letters of intent. So the difference between a letter of intent and initial indication of interest is, one, it's a lot more detailed. So it tends to be a single value. It tends to be a lot more detail on the legal terms of a proposed transaction. In some cases, it actually includes a markup of a purchase agreement. And so based on that, those final proposals, you tend to narrow the field even further. So from there, the process gets a little fluid. So in some cases, you tend to go with one party. They're the clear favorite. They're the best deal. And in order to drive forward to closing, you, in some cases, have to provide right of exclusive negotiations. So that exclusivity is granted to potentially one party. And in some cases, if the competitive dynamics allow for it, you can continue with just a narrower field for a period of time. But after final proposals, you're in that sort of final stage, right? So it's confirmatory diligence, right? So a buyer is coming in and doing all of their third-party diligence, whether it's accounting and legal, insurance and benefits, and all these different diligence streams, just to validate the story and validate the documents and everything in the business, and then also legal documents. So negotiating and documenting the transaction itself. So backing up a little bit. So if stage one, that preparation phase, right? So that's usually about a month or so. The initial marketing phase is called another month or so, and that third stage, right? So managing meetings and data room, it's usually another 4 to 6 weeks. And then that final stage of confirmatory diligence and negotiation of documents, that can take anywhere from 30 to 75, sometimes 90 days, depending on, again, different features of different types of businesses and processes and all the different documents that need to be done. So in all, it's a several month-long process, and there's a lot of work to do. But if you split it up into those little bite sizes, there's a lot of work there. So hopefully you get to a successful closing at the end. So I'll pause there, guys. Let me know if I missed anything or if there's anything you'd like to add, just with respect to the formal, like what a formal process looks like.
Sure. Matt?
Wow, that's a fantastic summary, Jake. I think so 3 takeaways. The first takeaway is when you listen to everything Jake just went through, like that's a lot. And so it goes to the previous point we talked about last time. Really good advice, a really good banker, a really good lawyer is worth their weight in gold as you go through all of these stages that Jake talked about. I think the second takeaway, like this takes up a lot of time. So to think that you're going to go through a transaction whilst doing your full-time job, especially if your full-time job is revenue and sales, like you got to really think through how do you accrue time to be able to go through that process with Jake, but also keep your customers happy, keep your revenue going, keep sales happening. Like that's hard to do those 2 things. You can't let the sales drop while you're going through a transaction, but 2 jobs simultaneously is tricky to handle. So really think through the mechanics of that. And then lastly, the process that Jake talked about, it can get exhausting and there can be some tough moments in there. And so being able to handle that process with consistency and transparency and interacting with a potential buyer in a professional, transparent, rapid response is really, really vital through the process, because they'll be constantly watching how you handle the process in terms of how you'll behave once the transaction's finished. So I've seen deals that maybe fall apart, not necessarily the mechanics, but more the style with how a seller handles the process. So Joe, back to you.
Yeah, and I'll sort of comment as well. And thanks, Matt and Jake. I'll give a little different perspective tied to what we do at Hueman and some of my experiences. We typically we'll do transactions that involve investment bankers. A lot of our transactions don't. The process is really the same. The only difference is sort of that marketing piece. An organization typically doesn't market their piece to whatever 5, 10, 15 organizations because they probably don't have that many contacts to be able to get to buyers, potential buyers. So that's usually a little bit different. But I think there's a lot of jargon that's out there. And Jake, thank you for not using acronyms. There's a lot of acronyms that you probably purposely didn't use, but you'll hear those things. And I think when you have an initial conversation with a buyer, they'll throw those things out because that's the world they live in. It's easy to be like, wow, these guys are intimidating. They're not doing that on purpose. It's just the world that they live in. Some people will ask, what does that mean? Or you're Googling it real time during a Zoom call as you figure it out. But you'll hear things like IOI, right? That's the indication of interest, or an LOI, a letter of intent, or an LOI light, right? Like, what does that all mean? And depending on who the potential buyer is or representation, that can look a little bit different. I think the only other thing a couple of things I'll add is the exclusivity piece is interesting that Jake mentioned, right? If you go and you actually select a buyer after the letter of intent stage or at the letter of intent stage, that exclusivity means you're still locked in usually for 60, 90 days, whatever that time frame is, where you can't sell to anybody else, you can't talk to anybody else. So pick that person appropriately or pick that buyer appropriately because you will be locked in. If you can get quality time between the buyer and the seller, great. Like the people that are going to be living together post-close, what does that really look like? My recommendation, if there is representation, get some one-on-one time. Like get the CEO or the head of growth, whoever it is, to spend some time with the founders, the people that are going to be leading the organization post-close. So you can like break some bread, go to dinner, spend some time where you see who these people are, because that's who you're going to be in the trenches with after the transaction ends, right? When everybody else leaves and the advisors leaves and everybody else gets paid, right? You're going to be working with that company. What does that really look like sort of post-close? And then I'll mention sort of something around deal fatigue, and we're sort of jumping around, but when you're in the beginning stages, you're looking for an indication of interest. It's exciting, right? You're waiting to figure out what's the valuation potential of my business, right? A lot of people are going to tell you a lot of things until you see it down on paper. It's not real. even when it's written down in an indication of interest, it's not necessarily real, but it gives you an idea of where the business will sit from a valuation perspective. We're not going to go through in detail today on valuations. That'll be another session, but you'll get that indication. You don't always have to go through an indication. Sometimes you just go to a letter of intent where you're asking multiple people for letters of intent. And then when you go through that, there is typically some additional information you're providing. So not just maybe summary level financials, they're asking about the growth plan. Maybe they want to know more about your team. Maybe there's another call or two. And you're still feeling pretty good because you got a lot of energy. And as Matt said, takes up a lot of time, but you're still focused on your day job and you can do that. After that letter of intent is signed, your world will change. It will change, right? It'll change, guys. You will be consumed. And the key is to understand what truly are the diligence phases you're going to go through between the LOI is when that's signed and the deal is closed. The quality of earnings, Q of E, another acronym, right? That could be grueling. Some processes do a Q of E first or most of the way, which could take 3, 4, 5 weeks, depending on how the financials are put together. And then you go through the other stages of diligence. So insurance, including health, anything related to sort of commercial insurance. There may be background checks involved. You may have other diligence that's happening you'll always have the legal side. Then you have the purchase agreement, whatever that looks like. And so ask those questions. What is the process? Because you may go through the Q of E and be exhausted and feel like you got through it all and you're not even halfway there, right? You got a lot more to go through. And that deal fatigue is real. And to what Matt was saying, you may start to get exhausted and get frustrated, and that comes out to the seller. And if things are not perfect, that could kill the deal. So just consider that what your stamina will be and be prepared for that. Matt and Jake, I just said a lot, so comment on those comments, please.
Just one comment. I don't know if you remember the panel we did together at the RPOA in Chicago last year. One of the questions was, this buyer keeps asking me all these questions. At one point, they asked 20 questions. And I'm like, that's not bad. Like, that's really good. That means they're leaning in and they want to learn about your business. Like, a buyer asking you lots and lots of questions is fantastic. Answer them and then go ask for the next 20 questions, right? Because the more they're leaning in, the more serious they are. Due diligence is supposed to be, yeah, it's hard work, but it's fantastic. And it's worth every minute of leaning in. But transparency is the most important thing, right? You got to be honest with every answer all the time.
Yeah. Well, if you don't, okay, Jake, please.
Well, I think it does speak to one of the things that we talked about in part one, which with respect to preparation, right? Not just the depth of your team, and to the extent you can balance, your team doing their day jobs, but also delegating some of the responsibilities and efforts required for this diligence process. And then also having the systems in place to be able to access the information that people are going to need, right? To the extent you can make that more efficient or make that a little bit smoother and easier, it's going to make this process go better, go quicker. You'll find it, and it ultimately will accrue to, all else equal, it accrues to valuation too. So to the extent you can do that preparation work in advance of launching, it will make it easier.
Let's shift the topic a little bit to one of my favorite terms, which is add backs. Right. So an add back, I'll sort of define what an add back is, and let's talk through how an add back can relate to how you're bringing on advisors on the front end of the deal and even along the process. So that little prep for you and Matt and Jake to think about that topic. So an add back is something that is an expense in the business that is typically non-recurring. So after a transaction closes, those expenses are not going to be in the business. A classic example is you have a founder that started the business. He or she is going to retire when the transaction closes. That person makes X thousand per year. That expense is not an ongoing expense. That would be an add back. So if a business had $1 million of earnings, now maybe they have $1.2 million of earnings because that founder's expense is taken out of the business. And that assumes that the founder doesn't have to be replaced. The rest of that management team can run that business. So there are add backs that are pretty simple to understand. Jake and Matt, tell me about some of your experiences with add backs, specifically around consultants, and then some areas and some add backs that are sort of hidden that could be real and could increase the overall EBITDA of the business?
The goal should be to present a picture of the financials that reflects sort of the normal steady state trajectory of the business. And so to the extent that historical financials include, founder expenses that would be going away post-close, non-recurring one-time items, or maybe, one-time investments that are impacting the near term but are accrue to growth in the future, right? These things should be considered on the front end when you think about the presentation of your financials in any process or in the context of any of these conversations. So it can take a bunch of different flavors. And Matt, I'd love for you to jump in with any examples that you have, but that's the basis.
So the best example I have an add back is us. So, the services we provide to a company that might be 3 months of recruiting or 6 months of recruiting is a one-time expense and is an add back. And so, like, not only do we use add backs in the business, but we are one for a lot of our clients. It's in the world of acquisitions and PE, it's one of my favorite phrases.
Yeah, and on the Matt, did you have anything else to add on that topic?
No, that was great. Thanks.
Yeah, and so I'll sort of mention I'll go back to the advisor piece, right? So if you're looking to bring on a financial advisor early in the process, maybe you want to bring on and engage an attorney to look at sort of your overall structure of your business, right? And they're charging you $500, whatever, $100,000 an hour, right? You may think, well, if I invest $20,000, that's going to hit my P&L. Well, it will hit your P&L, but that's a one-time expense. You're prepping to sell your business. That's not an ongoing expense, so that would be an add back. You still have to pay that person. It's still cash out the door, but it's not going to impact your P&L. So just tying that back to the first session, it is important to be prepared. And if you've got the cash to do it, get some advisors that are paid. They'll provide a different view of your friends that are maybe good in the industry, but have a different independent perspective. All right. Let's talk a little bit about valuation. We're not going to go into the details of how a valuation specifically is calculated. Jake, why don't you go first? Talk to us about how you sort of advise your clients to determine what's a realistic valuation. What are the 3 or 4 things that you guys typically talk about on the front end?
So I'll say it's very situational, and I would ask that let someone do some work on your specific situation and provide curated advice to your company and the metrics that these companies are value based off of. The one constant I would say in the RPO industry is that these businesses are typically valued on EBITDA, which is earnings before interest, taxes, and depreciation. That's fairly consistent. The multiple of that EBITDA will vary depending on a lot of these factors, right? Growth businesses get growth multiples. Higher margin businesses will get higher values. Businesses with more recurring revenue baked into their pricing structures and less customer concentration, which is to say more diversity, a focus or a specialization in high value industries like healthcare or like technology or like life sciences, things like that. Those will all impact valuation. So, and then the other one that I'd mentioned just from a more financial perspective is customer retention, right? So how can you prove with the data the company's ability to retain the customers that it has, grow within those accounts, grow wallet share within those accounts, but also to limit downsell within those accounts in tougher environments. So customer retention metrics are another big feature that are a part of every process today.
Yeah, the only thing I would add to valuation is I think people underestimate the importance of timing in valuation and to perhaps not just follow the crowd. I think in today's market, there are a lot of companies in the RPO sector just simply very hesitant about any form of transaction because they look at their valuation, look at their EBIT, look at their growth. But at the same time, if you can structure a deal where if you're optimistic about the growth in the future and you can use another firm's assets to accelerate your growth unnaturally, like that might be a great way to so to be able to unlock some future value versus just focusing a transaction on today's value. So it really depends if the acquisition target is a long-term partner, then you can make a lot more money on second or third bite at the apple versus just at the point of transaction.
Yep. Yeah, that's interesting, Matt. We've experienced that when talking to potential acquisition targets. And the industry generally has headwinds, right? And the headwinds are not 5 miles an hour. Depending on the week lately, maybe it's a little bit less here and there, but it's pretty consistent, and it has been for, depending on your business, 18 to 24 months, maybe longer in some cases. And so we've seen a lot of organizations, they're hesitant to transact because their earnings are down from what they were 2 years ago or a year ago. Their revenue is down, and their expectations of what their business was worth, the enterprise value, 2 years ago was a lot higher. And so there's sort of a mental adjustment where they feel like they can't make that mental adjustment. If the business was worth $1 million, it's not worth 500,000 now, even though the financials may actually show that that's what it is worth today. They think it's worth 900,000, right? 10% less versus 50% less. And so what we've seen is, so you talked about sort of structuring the deal. That's another sort of, not an acronym, but the term structure, right? Is there structure in a deal? We're seeing more and more of that, more and more structure. And I'll go in and describe sort of what structure could be and some examples of that. So if the enterprise value of a business is $1,000 and the business is growing, then you may get a check for $1,000 today. That's your business, right? If the business is not growing tremendously, maybe you get a check for $900 and $100 gets paid on what you do in the next year. We're seeing a lot of deals structured where less than half of the enterprise value, the total $1,000, is getting paid at close. And the rest of that, so maybe a couple of $100 is getting paid at close. The rest of it's getting paid at year 1, year 2, something in the future based on some type of goal that's hit. You know, for us, I mean, for the safest way for a buyer to deal with an earnout, which is what those things are called in the future, right? The safest way is if it's based on earnings. But the hardest way to have two companies integrate together is to have it based on earnings, because you don't want your sellers who are now part of the business to want to control costs when you're trying to make them more efficient and do good things all around growth. So we actually try to structure our earnouts around revenue. And we know that we're going to be aligned. And if we make a decision as sort of the parent company to invest more, that's a decision we make. We still want to grow our revenue and do more for our clients. That's sort of, why don't we talk a little bit about structure? Jake, do you want to sort of comment on what you're seeing on the structure side? I gave a couple of examples, obviously.
For sure. So when we talk structure, we're talking about forms of consideration, right? So for valuation purposes, is the form of consideration you're being paid in exchange for the equity of your business, is it cash? Is it stock in the new company? Or is it some sort of contingent consideration based on, you know, it could be time-based, right? So sometimes seller financing is a tool to bridge valuation gaps where, you know, you as a seller become effectively a lender to the new company and you earn an interest rate, but that you're getting paid over time, right? There's no other feature that's keeping you from getting that money except for the passage of time and the company being solvent. Or there's, you know, earnout consideration that Joe mentioned, which is performance-based, and that's often based on earnings, right? So that's been a tool over the past couple of years when, you know, trajectories have been a little bit softer than they had in the past, right? But if you still want to get a deal done, you can say, okay, it's a certain amount of cash and stock for the business today, but then, you know, earn out based on performance in year 1, year 2, year 3, based on you hitting EBITDA targets or revenue targets, or in some instances it can be event driven, right? So like you renew this contract or some sort of delivery mechanism, right? And that can be a way that you earn additional consideration too. So that tends to be the case, or at least the most common structures. In most deals, so think about the different flavors of buyers that we talked about in the last session. Pure strategic buyers often or tend to lean more towards cash consideration. Private equity buyers or private equity platforms that are, you know, making an acquisition as an add-on will tend to use some cash and some stock. It's pretty typical that a private equity deal would include some rollover consideration or equity being rolled into the new company as a way to align the incentives of the operators that are staying with the business. A tool or market condition that we've seen over the past couple of years is, in order to bridge those valuation gaps, we can have performance-based earnouts that allow, you know, those sellers to get back to that same level that they hopefully would have seen in the past, but earning into it based on the performance of the company.
Yep. Great. And it's interesting when you talk about sort of all the different components of structure. And Jake, I appreciate how you put everything in sort of a formal, very logical process map, if you will. when we think about sort of the structure piece and we're thinking about what the acquired company looks like, right? In some cases, so private equity will often invest in a platform. We touched on that a little bit last time. Larger organization that has infrastructure to grow, back office, and has the leadership to be able to do some other acquisitions. Those acquisitions that go to a platform typically are called an add-on, right? They add value in certain ways. Sometimes it's bringing them into a new industry, bring the overall organization into a new industry, maybe a new service. So maybe you have an RPO company that acquires a business that has some staffing or has some direct hire or does some talent acquisition consulting, right? But then you have smaller acquisitions that just are slightly additive to the other parts of the existing business, which you'll hear the term tuck-in, right? It's a little tuck-in because they may have a couple of good customers that you want to have because you have 5 customers in an industry, you'd like to have 7, they have 2 of them, and it just gives you that much better exposure to that industry and that expertise to be able to position yourself. So if you understand, are you truly a platform? Are you an add-on or are you a tuck-in? And this goes back to one of the earlier stages. That'll allow you to understand what type of structure may be offered to you, right? Because if depending on what you're looking at, if you're the platform, great. There's a lot of companies, I've experienced this before in my career, where you think you're a platform and you go out to market and you're really not. And you're like, wait, I really am, but you're not. The market doesn't look at you as a platform. You may be a large add-on, so that maybe there's a platform that is a little bit weaker. You can add to that. You got 1 strong or 2 strong leaders that can build out the platform. Don't take that personally. Your business is what it is, right? If you've got a 2-year runway, build it out to be a platform. But if you're not a platform, understand that. And then it'll help you to actually communicate that and negotiate, I think, through a clearer lens, if you will. Matt, do you have thoughts on that?
Yeah, I mean, I think that's a fantastic summary because if you think about our business, CRG, we're a platform that has add-ons and tuck-ins. And so you've got sort of the core platform, a tuck-in might be an executive search team in a specific function that we're already in, just adding muscle into that group, that industry sector. An add-on might be a new business unit, like maybe an RPO or a consulting or assessment and training that you can bolt in as a business unit that exaggerates cross-sell. And therefore, I think a lot of these you need to consider. Talk about the headwinds that you talked about in our industry, Joe. Now's like a perfect time, I think, to consider an acquisition. Because if you've had a rough time with EBIT in the last 2 or 3 years, like Jay talked about, and you haven't invested in your business, and you're sort of assuming you're going to accelerate at the next growth curve, well, all of your competitors are maybe making the same assumption. So how are you going to out-accelerate the competition at the next growth curve? That's very, very hard to do if your business looks identical to what it did 2 years ago or 2.5 years ago. So unless you've invested that EBIT to change fundamentally your business to accelerate your growth, you're really not an acquisition target during the next growth cycle.
Yeah, we look at it through the lens of an annuity, right? You're going to get paid at the close, and it could be cash in stock and equity, right? But if that valuation has gone down in the last 2 years, but there's value in the business and you believe in it, well, maybe if you're going to have $1,000 in earnings next year, you feel good about that, and a buyer is willing to pay you 1 or 2 or whatever times next year's earnings and do that for the next year, maybe something in the future, then you're going to get paid slightly in advance of that, and maybe on more than just what that is. So if you're going to bring in $1,000, maybe you'll bring in 2. It's not a bad way to consider it. Otherwise, you may wait 2 years and maybe things don't bounce back, and then you haven't been able to de-risk. Really depends on what your overall objective is. But if you're in that mix of you're really interested in doing something today or in the next 12 months, it's not a bad time to approach the market. You just have to think about the structure piece differently.
Yeah, exactly.
The internal debate with any sort of operator, founder, entrepreneur is timing, right? The opportunity cost of doing a deal today versus doing a deal tomorrow, right? And the execution risk associated with achieving what you think you're going to do tomorrow, right? Do you own that execution risk 100%, or do you share some of that in exchange for some consideration today? And there's no perfect answer to that.
And I was going to say, Jake, you talked to 100 venture capitalists or investors, right? They've got dozens of companies who just waited too long, didn't
Yeah.
take the deal when they should have, waited for the bigger bite, and it never came.
Jake, you had mentioned a lot of the earnouts are based on EBITDA and earnings from what you've seen. We've seen a more recent trend, not completely, but more recent trend tied to revenue. Are you seeing any of that from where you sit?
I see it both ways. The earnouts are hard because they're hard to document when you get to the later stages of a process, because you have to agree on a definition of EBITDA to the extent it's based on EBITDA. Revenue is much easier to find, right? So to the extent you can create a revenue-based earnout that still aligns everyone along the way, that's easier for everybody. But a lot of buyers we see, I would say the majority of them, if there is an earnout, it's going to be based on EBITDA.
Good. Yep. Yeah. Matt, how about you?
Yeah, same. I think we talked about both sides, ended up with revenue, but at the moment, to be quite honest, I think the issue we're seeing in the industry is the conversation we're having really aren't getting to that point, Jake. There's just a lot of hesitation around valuation. You sort of get stuck at the valuation point and never get to the, okay, is the earnout going to be based on revenue or EBIT? Because you're stuck 10 stages earlier in core evaluation.
Yep.
Okay. I think that wraps up stage 6. Lamee, it probably makes sense for us to work on stage 7 and stage 8 the next time we get together, just based on timing. So we'll focus on post-close and then integration and some other key considerations the next time we get together.